Hey, it's Dak Hartsock, ACI Wealth Advisors with the market risk update. After the gymnastics we've seen in the last week or so and the aggressive sell-off, I thought it's probably a pretty good time to let people know what's going on in the market. Hopefully settle you down a little bit versus what you're hearing in the media. For those of you that don't know me, I'm Dak Hartsock, Chief Market Strategist at ACI Advisors. And what we're going to talk about today is just this part that is in bold, which is basically understanding when you have a positive investment climate and when investment's likely to be rewarded, and when things are negative and investment is likely to be punished, or you need to risk manage down to avoid the worst of that. So let's hop right into it. And I'm going to talk kind of fast because I want to get through this in 7 or 8 minutes. So what we're going to review real quick is the 13-point risk management model that my firm uses to understand what's happening in the economy, what's happening in the market, and when assets are more at risk of falling and having a nasty negative outcome versus most likely being rewarded for continuing investment. So let's kind of hop into that real quick, because I know there are some of you that may be alarmed by what you've heard in the media, specifically things about how interest rates are going to destroy the economy, or the Fed's going to raise them too fast and the market's going to crash, or whatever else you might have seen on CNBC or whatever. So this is the first component of our risk management model. There are 3 components in here that we pay attention to. And what we've got here is we want to pay attention to what's happening with price. We want to pay attention to what's happening with called relative strength. And we want to be paying attention to what's happening in terms of the weighted moving average convergence divergence. Now, the technical stuff, the under the hood stuff isn't really important to you guys. What you do need to kind of think about here is what's actually happening and how it can impact investment. So very quick, we're only going to spend about a minute here. The red lines are when each one of these 3 factors go negative. And the green lines are when each one of these 3 factors gives a positive signal again. And what we do here is, like, the yellow line reflects prices over the last, about 200 days, a little more than that. The blue line here reflects price behavior over a shorter time frame. So what we see is that when this blue line falls below the longer term line, sometimes that can signal some problems in the market, as long as we see a relative strength that's also falling off this green lines here, which means it's overbought. So we want to see relative strength falling out of an overbought situation for a negative signal. We need to see that the shorter term price action has fallen below the long-term trend. And we also want to see that the volume weighted moving average convergence divergence is also giving a negative signal. And the converse is true. When it gives a positive signal, the market typically goes up. And what you can see is, even if you only followed this part of our risk management model, you basically, if you add up all the green parts, right, the 16% here and the 60% and 115 and 31, versus just buy and hold from the same point, you wind up with about twice the market's return. So, it's not infallible, right? Because we got a warning in 2015, and depending on if, you want to calculate this 0.5% from the close of the month, or, when you first get the signal, or when, the opening day of the next month, this can vary about 5%. You could have argued that this period actually went up 5%. The way I calculated it was down a little bit. But the point being is, it's not infallible. But even though it's not infallible, you would still be substantially better off, watching this component of the model and making some decisions based on that. So, but we don't. We've got more pieces to the model that help us truly understand what's happening and govern our risk management decisions. Here's another one. This has got 6 very important fundamental components in it. We call it the Recession Probability Indicator, or RPI. And what we've learned is, by looking at bear markets in the past, from about the last 100 years or so, serious bear markets occur during recession. And what the RPI does is help us understand when the U.S. is actually in recession, because that's when the investment climate kind of goes bad, or gets a lot tougher than it might normally be. And I want to highlight that this is not a prediction, right? We're not predicting when recessions are going to come, because no one in the history of mankind has ever been able to successfully predict the future. So we're not trying to be the first. What we are trying to do is understand what is happening right now, because that's what's important. And what we see is that the economy is very stable right now, or we're actually expanding, but this is confirmed by these 6 fundamental data points. we're not at current risk of recession. We're not in recession at the moment. So that means things are good, and that continuing investment is far more likely to be rewarded than is, maybe selling out or cutting your risk or whatever else. There's no guarantees, but the probabilities are strongly in the favor of rewarding continued investment. And just a quick word for those of you that don't know, this holds true in terms of spotting recession back into the late 60s, early 70s, which is as far back as these data points go. And it's 100% accurate to date in terms of spotting those recessions, like when the U.S. actually moves into recession. So that's important to know. All right. Now, this is based on Delito's work. I don't agree with every single thing he says, but in terms of understanding the market here, I think he's got it pretty much exactly right. And these are leading drivers of bull and bear markets, and they round out kind of what we use as the risk model here. And we want to watch 4 factors there. That's earnings, inflation, interest rates, and prices, being the market prices. And I've highlighted the stage where we're at now, which is essentially a late cycle bull market. And we've known we've been in a bull market, late cycle bull market for a while. Some people say, well, if we're late cycle, shouldn't we be getting out? And the answer to that is no. And that's because the late stage of a bull market cycle can go on for years. And if you exit just when you enter a late stage bull market, you can wind up leaving some very substantial returns on the table. And that's not really what you want to do, right? You want to continue to be invested when it is favorable to be invested. And that's where we are right now. Now, the media flipped out this week primarily over interest rates and how they were going to stifle the economy. And there's some truth to that, but you have to understand that rates are moving up slow. Earnings are positive and growing right now. Inflation is very moderate. And those are all great things for the market. The economy is expanding. But let's actually take a look at interest rates and see what's happening so that everybody can understand that despite what the media says, we're really in a very good position with interest rates. Now, this is kind of busy, and I apologize, but there really wasn't another way to get all this data on here. This top blue line, let's deal with this first, is the Fed funds rate, which is the big stick they use to control the economy, right? And the joke is that the bull markets aren't things that die of old age. They're murdered by the Fed. And the way the Fed murders bull markets is by raising rates consistently and mechanically until they stifle economic growth, and they then cause a recession, and that also causes market crashes and all the other things that we don't want to see. So what we've got here is the real Fed funds rate. And as you can see, these gray lines here are recession. And I've highlighted the Fed funds rates where they peak prior to each recession. And as you can see, you have to have at least a 1.5% Fed funds rate, and typically a lot higher than that, in order to murder the bull cycle. And now let's look at where we are right here, right? This is the current real Fed funds rate as of a couple of weeks ago or a week ago, and we're actually at negative 0.6%. So when you're in a negative real Fed funds rate, or even a neutral Fed funds rate, like if say this is 1% or 0.25% real Fed funds rate, then the situation is that's very stimulative, right, to the economy. It's a big positive. And if we look down on this blue line here, this is the market. This is the Wilshire 5000. That's 5,000 companies in this particular index. So it gets a real good look at what happens when interest rates get too high. And so you can track and see what happens, right? When interest rates get too high, then yeah, the stock market kind of goes down a little bit. If interest rates fall and then or begin falling, then that helps the market rise. Or if they're kind of neutral, right? Or if they're negative, that helps the market rise. Well, that's where we are right now. So the whole argument that interest rates are about to kill off economic growth and they're about to end the bull cycle, it's just not accurate. It's fear-mongering by the media. It's not the way you want to do things in terms of investments. You want to focus on hard data. You want to think about what is, not what if. The people that think about what if often find themselves missing out on some of the great things that proper investment can do for you and your family financially. So that kind of wraps this up. If you do have any questions, clients, just call the office. If you're not a client and you do have some questions, you can send me an email or whatever else. I'm going to hop into one last segment here. If you're not interested in what I think is going to happen from here, then you can sign off right now. If you do want to hear kind of what I think is going to happen next, then I'm going to talk about that right now. And here we go. What we've got here is the S&P. And for those of you that follow these updates, you might remember that back in the spring, in March and April, we were kind of right here in this area. And my feeling at that point was that we were going to kind of bounce around between this green line here, which is the intermediate term uptrend, and this kind of line that I drew here. I thought we'd bounce around, and then I thought the big probability was that the market was going to break out of this and move higher. And it turned out that that was right. So now let's talk about what I think might happen next. And there's going to be, I believe, two outcomes here. Both of them are going to, I think, be positive because all the fundamentals, as we just saw from the risk model, are still positive. We don't have any big risks to the bull cycle at this particular time. So what's going to happen, I think, is it's going to be like earlier in the spring in March and April, where it kind of temporarily dipped below the intermediate trend and then begins to rise again. And so we see this dip here. It could also be a situation where we see it break back through down under the intermediate trend and fall down to this blue line here. And if that happens, for those of you that follow, this is fair value for the market, then it's going to establish a new intermediate uptrend, I believe. So, again, that could mean the market's going to fall all the way down to here, which I think is another, I don't know, 4%, something like that, before it begins to follow the new intermediate uptrend and works its way back up. So out of these two outcomes, my guess is I would probably lean a little more towards the current intermediate uptrend reestablishing itself versus being in a position where the market establishes a new intermediate uptrend. But it's close. So we'll just see what happens. Either way, the investment climate is stable still, as we saw from the risk management model. And when that's the situation, continued investment is often rewarded. So that's what I've got. Thanks very much for paying attention. Again, if you're one of my client partners or one of the firm's client partners, you have questions, you want to talk about it a little more, just get in touch. If you're not a client partner, then feel free to send an email if you have some questions about anything we talked about in here. And other than that, thanks very much.